Hello everybody, William Jordan here. So today we're going to be looking at candle development and the basics behind candlestick patterns, how to look for them, what to look out for, and how to use them when you're working on different trading strategies. This is all just to give you like a leg up to help you out when working on set strategies. Let's have a look at this candle right here. Now, based on our previous video, we can clearly see this candle to be bullish. Large green body, and even though it's got a long wick at the top, this is clearly a bullish candle. The price opened right over here before going up to the tip of the wick and then retracing a bit where it finally closed right here. Now, imagining this to be a daily candle, depending on the software you use and what you're trading, of course, this candle can be broken down into smaller candles of shorter time frames. For example, hourly candles. If it was the Forex you were trading, it can be broken down into 24 hourly candles. If it was stocks, it can be broken down to 6 or 7 candles. It all depends what you're trading and which software you use, since some software only show market hours while others shows even after hours trading as well. The New York Stock Exchange is open from 9:30 a.m. to 4 p.m. So this big daily candle would be broken down into 7 different hourly candles. Now, if we break this candle down into hourly candles, we get somewhat of a different view. This is called candle development, breaking larger candles down into smaller time frames to get a better idea of market sentiment. The price opened right here, and we can see the majority of the bullish activity for the day was during the first hour of trading. The second hour saw the majority of the bearish activity, which continued into the third hour, but buyers came back in and the rest of the day was a lot harder to get any decent feel for the market due to there being a lot more noise as shown by the remaining candles. Understanding candle development is important since it allows us to better judge the way prices are moving. As we can see here in the second example, the same candle but on a different chart, being broken down into its hourly components, gives us a completely different view of how prices are moving. The price opened right here, and the buyers and sellers were fighting for control during the first hour. The second and third hour of market activity saw the bulls dominating, pushing the prices up ever higher. Then we get to a period of noise as the market was stabilizing before the buyers came in again very strongly, leaving behind a very strong bullish candle and reaching the highs of the day before the sellers came into the market, driving the prices down to the close of the day right over here. As we can deduce, this could have been a good trading day, hence the reason why candle development is of such importance. In our third example, still on a daily chart, we can see there wasn't a major victory for either the bulls or the bears talking daily, even though the bulls walked away with a slight victory. The wicks are pretty long, showing a lot of bullish and bearish activity. By breaking down the candle into its hourly components, we can see the price opening and the buyers pushing the prices up to the daily highs. As they started cashing out and more sellers came into the market, the prices dropped to the daily lows during the second hour. At this time, overall bullish sentiment and behavior made the prices go up once again, even though it wasn't easy judging from the sizes of the candles and the time it took to reach the second highest point of the day. For a trader, this movement from the daily bottom to the second highest point could have seen them gain a decent amount, but it would not have been easy to sit through those 5 hours and slow movement and sometimes uncertainty. The bears had the last say during the day, pushing the prices down to almost the daily opening price. So as you can see, candle development is a very useful tool when trading. It allows for deeper insight into the market activities and movements over a certain time frame, and it helps with developing more robust trading strategies. Now, candle addition is basically the exact opposite of candle development. It is simply taking a bunch of candles of smaller time periods and adding them up, putting them together to form one larger candle for a longer time period. It is helpful to understand overall sentiment over a longer time frame. A simple example would be what we saw earlier, taking 7 hourly candles and adding them up to make one daily candle. Now, candle development and candle addition can be done with multiple time periods. Okay, you can have 5 1-minute candles to form a single 5-minute candle, or you can break down an hourly candle to form 4 15-minute candles, for instance. Okay, there's a wide range of different time periods and time frames you can use with candle addition and candle development to use in your trading strategies. So in this example, we know that the trend was bullish overall, even though there was some choppiness and noise during the middle of the day. Adding this all together, we get the daily candle, which would help us compare with the previous days to get a more precise idea of the stock's performance over a certain time. The area of noise during midday can also be considered support or resistance for the future, and it should be taken into account. Of course, all of this depends on context. So candle development helps us to see the inner workings of a candle and helps us to get more detail of what is happening over a certain time frame, where candle addition helps us to see more of the overall market sentiment. So let us talk a bit more about candlestick patterns, what to look out for, and how to apply them in your trading strategies. Candlestick patterns can be broken down into basically 3 parts. First, we get the trend, which is the way the market is moving, upwards or downwards. Then we get the candlestick pattern in itself, which is an indication of potential opportunity to come. And then lastly, we get the confirmation, which is there to certify or refute our theory of the opportunity. Firstly, the trend. For a candlestick pattern to be of any value to a person, it must be situated within a trend. In ranging markets or markets which are moving sideways, patterns will more often than not be of little use to the trader. Now, since markets are trending almost 80% of the time, there is great opportunity for traders out there. So one should always look for the pattern within a trend, whether bullish or bearish. Then we get the candlestick pattern in itself. Once again, it should be looked at within a trend. Many traders make the mistake of looking at patterns but not looking at the overall trend. Lastly, we get to the confirmation stage. It is exactly that, a confirmation that the pattern has worked out and that the market moves in the way you were expecting, giving rise to an opportunity to get into a trade. There are different entry levels for a trade depending on how aggressive or conservative the trader is, but we'll see more of that in future videos. So one should remember to look out for the trend, then the pattern, and then the confirmation. Here it was a bearish reversal pattern. Since the trend was upwards, we got to the pattern and our confirmation showed a market turnaround, the bearish reversal pattern. Okay, one can make money in ranging markets or sideways moving markets, but traders are much better off when looking at trends. Remember, we're talking probabilities here. In order to lower your risk and increase your reward, you should look at the probability of a trade working out in the way you want it to, and in trending markets, that probability is much higher than in markets which are moving sideways. So at the example we just saw, the bearish reversal pattern is a signal for the trader to short the stock or the market and make some money in doing so. Here in this example, basically the exact opposite of what we just saw, a downtrend followed by a pattern and then a market move upwards, giving us the bullish reversal pattern. This is an indication to the trader to go long in a position. And even though it is never 100% sure, the probabilities are more in your favor of placing a good trade by going long. Now, as there are reversal patterns, we also have continuation patterns. Here we have a trend upwards, followed by a candlestick pattern, and then followed by another move upwards as confirmation. This only indicates that the uptrend before the candlestick pattern has a good probability of continuing after the pattern. Once again, never 100% sure, but it is still a good indication for entering into a long position. Same thing over here, but for a bearish trend. The market is moving lower. We then get to the candlestick pattern, and the confirmation indicates that the bearish market sentiment is continuing, indicating we have an opportunity for entering into a short position on a stock or index. So one thing to keep in mind when you see a reversal pattern within a trend is that the market is not necessarily going to make a sharp reversal right after the confirmation you just saw in your pattern. Sometimes it does, of course, but other times the reversal can be very gradual, or the market can even continue sideways a bit before the reversal actually kicks in. In certain cases, the reversal can be extremely short-lived, or the market can even continue in the trend it had before the pattern, making the reversal pattern fall completely out. Time frame of influence can range greatly when trading reversal patterns. Do not expect a reversal to continue for 1 year in the future if you saw the reversal pattern on a 15-minute chart. The time period you can expect to see a reversal in is, in general, between 1 and 7 candles. Now also remember, this is not an exact science, so do not go out and say, William Jordan said that the market is going to turn around. The probability is only more in your favor for a reversal. As to why you should avoid trading in ranging markets. If the market is moving sideways and you see a candlestick pattern, it can mean that there will be a continuous side movement, which isn't good for traders since there is little money to be made on a sideways movement. Stock prices need to change in order for one to gain money. When in a ranging market and the reversal pattern pops up, does that mean that there will be a market reversal? No, the market cannot move backwards when it's ranging. So basically, when you see a candlestick pattern in a sideways ranging market, it can mean that the stock will go up, continue sideways, or go down, giving one lower probability of picking the right choice when it comes to entering a trade. A last thing to know when trading candlestick patterns is that the patterns are not the best or the only indicators out there. You can very well see a candlestick pattern pop up in a trend, but other indicators out there point to different overall market sentiment. And if you're using only candlestick patterns for your trading in those moments, you might get screwed over royally and end up losing a lot of money with your trades. Candlestick patterns are only one of many tools out there available for trading, and it should always be used in conjunction with other indicators available to the traders out there. In the next couple of videos, we'll be looking at the different candlestick patterns and formations and how to read those patterns in the stock charts and how to put them to better use in your trading strategy. So you definitely do not want to miss out the next couple of videos on my channel. I hope you enjoyed this. If you did, remember to give me a thumbs up down below. If you're not subscribed yet, please subscribe. It would help me out greatly. This was William Jordan from the Moneymaker channel. See you guys in the next video.